Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers, where I challenge you to replace the 10th of an hour of billing with the 10th of an hour of learning. We're going to take a big bite of the apple today with this episode 16. This is a presentation more for wealth professionals, especially those who prepare estate tax returns, and we're going to explore a little known estate tax credit that you can get for gift taxes that were paid out of pocket during life under Code Sections 2001B2 and 2001G. Now, I was motivated to make this because there's not a lot of guidance out there on how exactly you calculate this credit, because a lot of software will do this for you, but it can definitely throw a wrench or a benefit in the estate tax calculation if you are generally unaware of the existence of this credit. So, in a perfect world, other than with time value of money, the estate and gift tax laws are largely unified, which means that they're designed to remove any advantage or disadvantage to paying gift tax on lifetime transfers versus paying estate tax on transfers at death. So because of that, the estate tax is usually applied to two buckets, one being the taxable estate, which is valued at date of death fair market value, and the other being adjusted taxable gifts, which are valued at the date of gift value. And with these two buckets, you get your full exclusion. So if you used up any of that exclusion on lifetime gifts, you're not necessarily dinged for that. Instead, what you're doing is running a cumulative calculation on the estate tax return on all property you own at death and all gifts that you've made during life. The only difference between the two buckets is the value, date of death value versus date of gift value. And it's important to note, based on some of our prior discussions, that if you make a gift and retain control or use over that gifted property, it can be shifted from the adjusted taxable gifts bucket up to the taxable estate bucket. And the big difference is that any post-gift growth in the value of that property will then be subject to estate tax, which nullifies the whole gift tax reason for making lifetime gifts. But putting that aside, the problem is that this works well as long as the gift tax rates and exclusions and the estate tax rates and exclusions are unified, but this hasn't always been the case. They used to be disjoined, especially back in the early 2000s. Up until 2001, the gift tax exclusion was only $1 million, and it wasn't unified with the estate tax exclusion, which went up to $3.5 million in 2009 before the optional 2010 sunset of the estate tax itself. And rates were different over time as well. The top gift tax rate up to 2010 was 45%, then it fell to 35% in 2010, then increased to 40% in 2011. So reconciling the difference in rates between time of gift and time of death is necessary to achieve this tax neutrality. So, looking at this, it's easy, if you think about this calculation, to potentially get dinged for making any gifts where you pay gift tax out of pocket during life. So because of that, the IRS does allow you a credit for gift taxes paid out of pocket during life so that you're not double taxed on the same gift. But the difference is that you don't necessarily get a credit for the amount of gift tax that was actually paid out of pocket. Instead, what you get is a credit for the amount of gift tax that would have been paid out of pocket if you had made the gift in the year of your death using the rates that are applicable in the year of your death, but using the exclusion amount that was applicable at the time of the gift. Now, there's a few wrenches thrown into this. One is that if there's a portability election made for a previously deceased spouse, then if a surviving spouse is making gifts, they must use up that ported exclusion first. And also, any gift tax paid out of pocket within 3 years of death is also included in the gross estate. Both those points are aside from this credit, but could affect the calculation of this credit. Now, for sake of simplicity, I'm just going to illustrate 1 year of gifts. This becomes complicated if you have multiple years of gifts reported on gift tax returns. But for simplicity, we're going to assume a taxable gift of $2.5 million in 2008 with no other lifetime gifts. Now note that the term taxable gifts assumes that any gift tax annual exclusions were already subtracted. That exclusion in 2008 was $12,000 per donee of a gift. It's now $15,000 per donee of the gift in 2020. Now in 2008, the gift tax rate was 45%, as I mentioned. However, in 2020, it's only 40% on gifts in excess of $1 million. Now, the gift tax paid in 2008 using that 45% rate would have been $675,000, which is essentially 45% of the amount over the $1 million of gifts that are excluded. Now at death in 2020, that $2.5 million is included in the adjusted taxable gifts, but this time the highest rate of tax is 40%. But long story short, what that means is that the gift had generated a $675,000 gift tax in 2008 and also generates an estate tax in 2008. We're going to assume, using the unified exclusions and rates, that the estate tax on that amount will be equal to the gift tax that would have been paid in 2020 had that gift been made in 2020. So when we recalculate and reconcile, what we find is that if the gift had been made in 2020 using the 2008 exclusion but the 2020 rate, the gift tax paid out of pocket would have instead been $600,000, which shows the reduction of that top rate from 45% to 40%. But long story short, what happens here is that you get a credit of $600,000 against any estate tax liability before applying the applicable credit, which is tied to your exclusion of $11.58 million. So you lose a little bit of gift tax paid out of pocket here. You lose $75,000. There's no credit for that just because the rate was higher, but you do get a credit for the gift tax that would have been paid out of pocket had the 2020 rates been applicable at the time of the gift. So that was a complicated discussion, but this sets the stage for a more important discussion we're going to have soon on another credit you get for changes in the basic exclusion amount over time, which is set to be reduced in 2026, if not sooner. So stay tuned for that. In the meantime, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thanks again for listening, and I look forward to seeing you in the next episode.